All right, we are less than 24 hours away from the upcoming CPI report that a lot of people are looking forward to and apparently looking pretty positively forward to it. So we're going to break down kind of how we may respond positively to this report and from a technical perspective, what that would mean and what kind of what kind of breakout it would signal. And what we kind of need to see to really be bullish and follow through and get going from here. On the other hand, we're going to take a look at what the environment is currently set up for and what it is suggesting beyond just the last couple of days, but the overall picture of the last few weeks. What's the technical environment setting us up for, and what should we expect to see tomorrow morning? So I'm going to break that down. We're going to take a look at the major moves we're seeing, especially here in this last couple, like about 6 weeks or so. This really good rally we've had coming into this report through a lot of major events, earnings season, jobs numbers, FOMC, everything that we've seen that's led to that have produced this rally. Do we have enough juice left? And then we'll take a look at one area that has not participated in this rally that appears to be returning, like gaining a relative strength. And we'll talk about how to trade that with one of the big leaders in that sector. So let's go ahead and get started. Today is Monday, February the 13th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I did today at 3:30 Eastern Time, as well as our new Telegram channel that we have for our premium subscribers to be able to interact with each other throughout the day. Come down here, click on this heart. It opens up this tab. Hit that like button. Same thing here. Click that thumbs up icon. Click that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. It really does. It's a huge deal for us. It's a way for us to get our word out there and help people find us. So we appreciate everybody who does that. And those who don't, you can do that right now while you're watching. Just take a couple seconds for a couple quick clicks. All right, let's take a look at the S&P 500 with the market forecast indicators. You can see a nice little rally today, up more than 1%, kind of recovering essentially what we lost on Thursday for the most part. In fact, more than recovering, because Thursday we gapped up, fell to new lows, and then now have recovered past Wednesday's close to the high point. So more than recovered that. You can see the momentum line, near-term line predictably moving up to the upside. Momentum line moving almost into the upper reversal zone. Again, you would like to really see it get, all these other attempts you can see, it just doesn't get going to the upside. And then the near-term line ends up exceeding it, and this is not what you want to see. So it'd be really good with tomorrow's CPI report. It'd be really good to really break out and get the strong momentum line to follow through on this, get above these highs. And most likely we'll get a pretty decent move tomorrow. And if it can break out through these highs with a strong momentum line up above, like say the 90th percentile, which would require probably a bigger than average day, which wouldn't be surprising, and it would also require closing near the highs of the day, which also wouldn't be surprising considering the market's reaction to previous CPI reports has been relatively bullish here, at least the more recent ones. So it wouldn't be surprising. Market's pricing that in. You can see the market's been pricing it in essentially since the January report, which came out somewhere over here, I believe one of these days. It came out there, and it's been rallying ever since. So it's anticipating a good report. It's anticipating, anticipating things the Fed says they're not going to do, but that doesn't matter, right? All that matters is investor sentiment, and investors may believe what they want to believe and buy for whatever reasons they want to buy, and that's kind of what we're seeing here. And you can see if we were to get above all these highs, we would also be getting above really important, like narrative changing Fibonacci lines, right? The 50% retracement of the correction that we've been on. Which, remember, getting above 50% of a correction typically means you don't ever get back down to these lows. and then the 78% retracement of this intermediate decline that we've been retracing for a long time now, we would finally be breaking out above that level. And then finally, getting above 4,200, just a little bit higher, would get us above this 23% line and essentially end the post-COVID retracement, this decline. This basically would end this correction. Now, obviously getting above up here would end it officially, but it would at least, it would end the post-COVID, the correction off the post-COVID rally. Is what that would suggest. So really significant trend, like narrative changing lines that could send us up, like I said, to those Tom Lee rallies that I think a lot of us are hoping for. Whether or not that's realistic is another case, but I think whether we believe we'll get it or not, I think we all want it because most of our portfolios are, at least long-term portfolios, are very heavily bullish in the deltas. So we are above the 2.5% mark, above the moving average at 3.25%. So we are, we're above that. We've got dark green shading and a green line and a half for a while. So very good moves from that perspective. Looking at some of the other indexes, the Dow Jones Industrial Average finally went back to dark green shading and a green line. So the intermediate line turned back up. And that's the kind of momentum line we kind of hope to see tomorrow. And you can see we didn't clear above a bunch of highs, but this is the highest close that we've gotten on the Dow for quite a while. So you're that close to a real good breakout on the Dow here after being really sideways for so long. So good move there. The NASDAQ 100 is the most bullish index today. And you can see a nice little bounce up too. Again, it's well above the moving average already. And short-term sentiment's not as bullish. So we need to really kind of follow through with this tomorrow post CPI. And then you can see the Russell still hasn't produced the dark green shading yet, still light pink shading. But remember we talked about, if that's all we get, if we can just keep this pullback to light pink shading and maybe yellow line, that'd be very, very good for us. And so far that appears to be the case. It looks like like I said, the market's pricing in with this little bounce here that we're going to bounce up. We're going to continue to bounce tomorrow. And so, that would be a good sign for a lot of people if we can get going there. So that's what the market forecast charts look like. If you look at the weekly chart, remember we talked about the idea of getting a lower high. We're only one day, and tomorrow's going to significantly change this. As of right now, it's another lower high, and it is a higher close. So we're getting still slightly higher closes despite the lower highs. And we're getting a golden cross this week. The 10-week is crossing above the 40-week for the first time, even though the differential is getting the Hakinyashi candles are getting smaller. That would suggest we're actually going to have a bearish candle here, but again, we're either going to get a new high, more than likely, we're either going to get a new high tomorrow, or we're going to be in the midst of this kind of a candle reversal like we saw in August there if it continues lower tomorrow. Let's take a look at the 3 green arrow charts. We have two green arrows here, so we still got no green shading. We still got 2 red arrows there, we got 2 red arrows there, and we have all 3 green arrows in the Dow. So new set of 3 green arrows, so we're back to green shading. No pink shading, so far so good from that perspective. Pink shading is when you get that 3 red arrow signal. Looking at this, you can see we're well above the 8 and 17-day moving average. The MACD is still below its moving average, so we're still in convergence mode, which again limits upside returns. That's on the SPY. The Dow, you can see the MACD is really, it's been so flat, and it's really close to break. In fact, I think that actually is, let's see here. It's close at minus 0.03, so it's really, really close to turning positive. Again, we're above that moving average. That's the diamonds. The Qs, we are easily below. The MACD is easily below its average, stochastics as well, and we're still above the 17. So we're still in, like I said, convergence mode there, and the same thing in the Russell. MACD and stochastics both below their moving averages, still above the 17-day, and for that matter, the 8-day. So again, convergence modes are limiting on their upside returns. Ideally, a good strong return can break us back above these moving averages on both of these oscillating indicators down here. Looking at some other oscillators, you can see the DMI has already been positive. Unfortunately, the negative indicator just can't drop, and that's what we need it to drop more to get the ADX to really take off. I mean, this is about as high as the ADX got over here, and we peaked with that cluster, and here we are again with another cluster, and we're not really taking off because we can't get that negative indicator to get down. The positive is above 30, but the negative is barely below 20. It needs to be more than that. The RSI and the CCI, again, we're trying to get back above 60. We're still in the upper, we're still holding the upper half of the chart on the CCI, so that's really, really good sign there. Looking at the stochastic indicator where we are relative to the range, we're still below the average. We are back above the 80th percentile, but we're still below the average. So we need to break through that to the upside tomorrow and really solidify this move. The hull, you can see the candle had broken down with a bearish candle on Friday. But now you have a higher low, a higher close. So a close above today's candle would be really good. Obviously the hull's still red. Obviously the parabolic SAR is still up there. But again, we can flip that parabolic SAR with a good strong move tomorrow if we can get through these highs and get a good strong bullish candle that gets our differential up above that outside of the 2.5% channel to the upside. And then get this PPO back above its moving average. So as of right now, they would all these indicators suggest that we're more than likely going to be down tomorrow. But if we can reverse that and really break up to the upside, then we have some long-term potential. But if we follow kind of the patterns that these indicators suggest we'll follow, then we're more than likely going to have a down day tomorrow. You see that as well. In the McClellan oscillator, again, the summation index is dropping. But you also see that like the oscillator itself is still negative. So it's not like, now it's not below, it's gotten back above the minus 35 level, but it's not gotten above 0, nor has it got above positive 35. Again, that would suggest we're more than likely going to be negative tomorrow. But if we can, again, break out pretty strong, then we can change that and change it to the upside. It's just, it's less likely that something like that's going to happen. You're not in the upper quartile, you're close. Man, if we can break above the upper band and get 100, at least get above the Keltner channel tomorrow, which would mean that we're getting above these highs, that would be outstanding. The bands themselves are outside the Keltner. I mean, we've been losing momentum. So again, the expectation would be you're probably going to continue to lose momentum until these turn red and the bands themselves get back in the Keltner channels. But again, that's a likely scenario. But if we can break out and get into the upper quartile again, get up closer to 100, get up above the Keltner channel, then that would be, you can see how positive that would be. Looking at today's range and volume, you can see today's range was 4.73 points, a little bit below the average, 64. I mean, not surprising when you got a big news event the next day for volume and range to be below the average. Both of those are really, really low. Like, you can see the ATR relative to the price is still at the 1.5% mark, but you look how close we are to breaking it. If we can break it and hold that break, then we are bullish, right? That's kind of what you need to see. You're probably going to get it'd be like tomorrow. Here's the ideal scenario. Tomorrow, it would be really ideal if we were to get a breakaway gap, right? Because you're going to get the CPI in the morning. So if the market can really respond positively to that and say close up, gap up, say up to here, maybe the 417, in this area, so get above some of these highs, then that would be a breakaway gap. If we can get to the 419 or higher, it'd be even better. More than likely it's not, but if it does, then we just run away from the open and without filling any of it in, then breakaway gap, great, here we go to the upside. But if we were to gap down with a significant move to the downside, right, it would be about 8.85 is one standard deviation. So anything that's 1% or more to the upside or the downside, and then we just run away. And then we just keep going from the open. Then we have the opportunity for a runaway gap, which could start a bearish intermediate trend. So again, more than likely we're going to get some kind of gap because this news will come out in the morning before the market opens up. So we're going to get this gap, and if it can be an opening gap to the upside, then we would get a new 4-week high point. we get this back up to 100, restart that clock. Getting to 100 usually means you'll at least be at 100 for a few days. So that means more new highs. That would pretty much reset the clock for probably another few weeks. But if we don't get a new high soon, then you can see the green line's continuing lower. Once it gets below 50 is a really high likelihood that you're going to get, because again, this low point, by the end of this week, this low point is going to be up here. So we're going to, if we can't get a new high and we instead get a runaway gap to the downside, which again, that's my expectation, is that we are going to get that kind of a gap to the downside, then again, you're more than likely going to get the breakout of the range with a downward move instead of an upward move. Obviously, anything can happen, but considering where the VIX is, the VIX, jumping up today above 20, not surprising. Got a big volatility event tomorrow, jumping up above 20. The VIX dropping though, so it started up, but you can see the VIX correlation with the VVIX is still at 90%. The VVIX is still really high, so it made that jump up to 94. It's still holding there. So that means you're going to get it's implied that you're going to get a big move on the VIX. And more than likely, our big moves on the VIX are to the upside and not to the downside. And especially considering, like we talked about before, the correlation of the VIX to the S&P 500, which has been up above, or at least I guess above this minus 50% mark. It's still kind of up there. So it's still a very weak negative correlation, where generally it's pretty strong. Those kind of different correlations tend to lead to volatility bounces, especially with the VVIX already implying that, and especially considering this is a volatile time of year for the volatility index. We tend to make a run into March expiration on volatility. So, all those factors again would suggest that we're more than likely going to get a move to the downside. But you can see that if we get the gap to the upside, how it can really impact these longer term return expectations. Like, we're not just going to go up to like 4,300 and stop. We're going to go up to new highs. If we break out here, we're going to get up to new highs, and we're, the correction is over. We're gonna continue this move, and it doesn't take very long to get to correction highs, to recover correction highs. It takes multiple years to correct bear market, to get back to bear market highs, but it takes only multiple months to get back to correction highs, and we've already taken a year, so it's not going to take very long at all. There's a lot of pent-up buying pressure that can explode if we move up to the upside. Again, the likelihood is lower that will happen, but we're kind of technically, from a technical analysis standpoint, we're on the precipice of that happening, especially if we can get that breakaway gap coming off that news announcement tomorrow morning. The last thing we kind of need to see is a gap to the upside that we fill immediately once the market opens up. That would not be a good sign, and would more likely be relatively bearish for the market. So, Walter Deemer tweeted out, and I kind of quote tweeted it, that the last time we had this October release, we got down on a really strong report and then rallied throughout the rest of the day. But the problem was, we were down, the 6 weeks going into that, we were down 10.5%, 10.25%, something like that. So over 10% going into that meeting. And we had that strong report. Well, this time we're actually up 7.5% over 6 weeks going into this report. And if it's stronger than expected, as expected to be stronger than it was that month, then we might gap up and then do the opposite, which, as you saw, as bullish as that was with that engulfing, it might be a pretty significant bearish engulfing if we get the opposite of that, or even just kind of some kind of dark cloud or piercing line, any kind of or dark cloud or whatever when we gap up and then fill in the gap and come down into the median of these bodies here, it would suggest bearishness going forward from here. All right, now let's take a look at what's driving a lot of this price action. You can see again, international stocks really doing well. Of course, all equity asset classes really jumped up, and they're doing pretty well here. But long-term bonds did too. which was a factor for today's strength. The dollar was down, commodities were down. So if you just look at today alone, February the 13th, if you look at just today alone here, we kind of had our typical bullish patterns here. Bonds are up, stocks obviously up on that, which means yields were down, commodities down, dollar down. I mean, that's the recipe for bullishness, is to get those factors working in our favor, and that's the direction. That's actually in our favor. In fact, if you go all the way back to when kind of this latest bullish leg starting on January the 6th going forward. Let's move this to like a 15-minute chart. So that January 6th would be from this day right there. So starting on that day going forward, when we really broke out right there, held that support and broke out to the upside. You can see the Qs really took off. The Qs are up actually. I mean, that's only a little bit more than a month. That's a month and a week ago, and we have a 16.5% return on the Qs. At one point was up 20%, nearly 20% there. Of course, the big reason is the strong weakness in the dollar. That's a big move for the dollar to the downside. Another big reason is the weakness in commodities, which, at one point was negative for this period, and it's still only up 3%. And you can also see long-term bonds were a lot more positive over here. When we were at the peak, that was when the dollar was at its low point. That's when commodities hit their low point. That's when bonds hit their high point for this period. So bonds are still, they're down from that high point. So stocks aren't, at their highs, but they're still positive, right? So that's the move, right? You can see the Q's taking the biggest advantage. IWM's up 11%. Developed markets really taking a big advantage as well. Emerging markets not benefiting here recently from the weakness in the dollar. Gold isn't either. It's actually down. It's pretty much matching. Obviously, it's underperforming equities, but it's matching bonds, both corporate and treasury bonds, essentially. So it's really underperforming despite the weakness in the dollar there. If you take a look at today's move again, one of the big reasons is the dollar, the drop in the dollar. That doesn't look like it's significantly changing, though that point of control as of right now is holding up pretty well. Long-term bonds, you can see they bounced up today, but remember they kind of broke down last week, Thursday and Friday, off of their resistance level. And you can see MACD and stochastic still below their moving averages, so that doesn't look like it's trend-changing bounce. Commodity prices, the other three-headed monster of that, you can see it rallied. It's still at moving averages. We rallied off of the open. It was down 0.25%. But again, you can see it appears that the low has been kind of built in, and especially here on the weekly chart, that we're trying to figure out, that the MACD to the downside has already bottomed, and then we haven't got any renewed strength, and the MACD itself bottomed here. And now we're just kind of grinding and converging to the downside, waiting for either a move up to the upside or a continuation of this correction to the downside. Here's TLT. Again, we've moved up to this 23% retracement, but last week was a pretty significant breakdown. And the MACD has already peaked. The histogram has peaked. The MACD appears to be peaking and rolling over. Of course, that would mean bullish yields. And then the dollar, same thing. Like the MACD already bottomed, histogram bottomed, the MACD looks like it's bottomed. We had a pretty good bullish couple of weeks here, and today it doesn't appear to have changed that yet. So again, one day, it hasn't really reversed the last 2 weeks worth of, in fact, if you were to go back to like when the dollar really started to move higher, was February the 2nd. So it's almost 2 weeks ago. If I were to go back to this asset class comparison chart and then just start it back on February the 2nd here, you can see again the dollar's been the strongest asset class. Yields have been rallied. Gold really is struggling with that strong dollar, and equities are lagging. They're not lagging significantly. The Qs are up 1% over that time frame, but international equities, especially emerging markets, are down. High yield corporate bonds are down, and that's been an issue. You see when you look at the spreads here, especially between high yield and kind of that intermediate term treasury that's often been linked to it, you can see the breakdown there. That's a pretty I mean, we're below the 17-day moving average on this relative strength, and that we had this divergence on the PPO, and we appear to be rolling over. The long-term PPO appears to have peaked and maybe starting to slow itself down with some of these other oscillators working their way to the downside. The other version of that is the LQD version, and you can see it's also broken below the 17-day. And the MACD is rolling down, and the long term appears to be holding. The CCI with a divergence there, the MACD with a longer term divergence coming off of a move above 70. So the credit spreads appear to be suggesting again that we're more likely going to come out of the CPI report to the downside, more to the upside. At least that's what the bond market is suggesting, especially when you look at the bond yield, the expectations, like the going into this meeting. You now have a 100% chance of a rate hike, but you have a 12% chance of 50 basis points at the next meeting already, 12%. And if you look at like the 3-month, it's up to 4.81, but the 10-year was down, so the spread is all the way down back to 1.12. So just like that, the spread here is back to near its lowest levels of this cycle. And again, for this to rise, it's not bullish for equities. It's actually pretty bearish for this to rise. But when you're inverted, it doesn't stay inverted for an extended period of time, because people start to take advantage of the fact that they can get higher returns in the short term than they can in the long term. So they sell long term and buy short term to get the safety there. So eventually, it's going to work itself back out, and the inversion is going to go back up to 0 or higher, but generally it's not very bullish. It's not bullish for risk. It's not a risk appetite trade to sell long-term treasuries and buy short-term. It's usually a safety trade, and so it does. That's the issue with inversions. They don't stay inverted for very long, and when they uninvert, it's not necessarily a risk appetite. It's more of a risk aversion trade than anything. The new highs and new lows, the breadth, I showed you the McClellan oscillator. The breadth is also still pretty weak. Like, we did jump back up. We almost dropped to the negative levels on Friday, but we did jump back up, still below 100, right? And definitely still below the moving average. And that's, again, getting below that moving average on the breadth, and the moving average is falling, is again another sign that we're more than likely going to come off this peak to the downside rather than breaking through. Of course, anything can happen, and if we can get a good response, great, but the expectations are less likely. You can see that. Something else that kind of stood out to me too is, we have, the number of stocks that moved above their 200-day moving average really jumping up, all the way up to 2 standard deviations above their 1-year mean, the 1-year mean at 40%. So really big move, higher than the peak that you had in November, and obviously way higher than the peak in August on the number of stocks above their 200-day moving average. But the number of stocks above the 50-day moving average is not matching that strength. In fact, we actually have a lower high on the number of stocks breaking above their 50-day moving average. Let's see if it gives it a second here to load this up. There we go. So you can see we were off the November high, and for that matter, off of the August high. So both those highs were very strong. This one, we only have 70% above, 73%. So you can kind of see that it's like, oh, we're not really getting that strength. In fact, it's kind of showing that we're kind of weakening here. Again, the 200-day is really high, but the 50-day is at 1 standard deviation above its mean, which is obviously a little bit higher. But still, you can see the divergence here of lower highs with the higher high in the index, as well as the higher high on the number of stocks above their 200-day moving average. So we're not. We're kind of losing the breadth in a lot of this move to the upside, and that's what we're seeing in the McClellan oscillators, what we're seeing in the money flow. That money flow is still not there yet. This peak that we had on money flow over here on the last cluster that we had in November, we're obviously above those highs right now, but again, we're still not eclipsing that level on a money flow basis, and we're flirting. We've been getting lower highs and lower lows on the money flow index, so we're still flirting with breaking down. And again, the trend suggests that we're more than likely going to follow down. Obviously, If we get a good move tomorrow morning, that'd be great. But the expectation is, even based on that, off of all this breadth signs, that we're probably not. That we probably used up a lot of this energy in pricing in this number, whatever it's going to be. We probably used up a lot of energy to get to this point, only to run out of it, because we know the bears are around. There's been a lot of bearish attacks here over the last so many days, whether it's intraday or pre-market. The bulls have been able to hold on to this trend, but the bears are around, and so the question now is whether the bulls will be able to overwhelm them tomorrow, especially in the lightly traded pre-market session, and then obviously run away with that from the open once the volume floods in. That's kind of the ideal situation we'd love to see tomorrow morning. If you look at the sector rotation, and again, looking at how things have moved here today, let's go to just today first, and then we'll take a look at the same time frame we looked at before. You can see XLC, XLY, and XLK. Those are your big movers today. That's a risk-on trade. Everything's looking really, really good, and energy lagging behind. If I go back to that same January 6th time frame, you can kind of see that those have been the biggest winners, and that's kind of what you want to be the biggest winners. And this are your losers, and those are the three things you really kind of want to be your biggest losers. You look at the 12 grid for this right here. You can see those same three areas across the top. This kind of bullish cyclical area, some light pink shading, but we're setting up for a dark green shading in the move. You can see we're at 3-month highs on most of these indicators, including financials, including industrials, are near highs. A lot of these are, and really it's the safety trades, utilities, staples, healthcare, that are on these bearish trends still, which, again, this is kind of what you want to see. You want to see especially these areas up here at the top lead a move higher instead of the other way around, right, where they lead a move lower. If you take a look at their rotation right now, let's see here, let's go to the sector ETFs. If you look at the rotation, you can see they are moving up to the right. Technology, discretionary, communication services, all moving up to the right. And even on the daily, even if on the daily chart they're not. So they're starting to, if you look at, like, for an example, you saw the XLC. Man, XLC has been so bullish. Here you can see the big move it's had, pulled them back a little bit, but it's changed that relative strength trend. The moving average for relative strength has moved up, but the problem is you have some negative momentum and you have this big discrepancy in relative strength here. You're probably going to get a continuation, a rollover. The hope is that you're able to get a change in leadership like we did in 2021, to where we can still be bullish even if it's not led higher. The problem is, and again, considering how these indexes are market cap weighted toward these sectors, it's not necessarily the best sign that they're already kind of peaking in their relative strength and potentially rolling back down going into the CPI. So again, another suggestion that we're more than likely going to roll over. On the other hand, something like healthcare has been really bearish, and its relative strength has been very down, and now appears it might be gaining some momentum, crossing above 100 and starting to pull this line up, coming off of these lows back towards its moving average. All right, so that brings us to our trade idea, and I wanted to take a look at AbbVie. AbbVie has been really bullish. It's had a nice little post-earnings move to the upside. Ended up with a long upper shadow last Thursday, but then Friday and then now today moving it, pretty much filling up the rest of that gap. The high point there at 153.70, and today 153.73. So technically breaking through there, though not by a lot. Obviously the momentum line still hampered by that long upper shadow, but the near term line really taken off. You can see we're 1% above. We got the bear tag. So this can really be, bear tags can either really be bullish or bearish, we can kind of peak, and it might take a couple more days, and then we roll down, or it can start a new bullish move to the upside, considering we're coming off of a higher low point. The intermediate line's rolling up. We've talked about healthcare's underperformance. It's also starting to roll up from really low levels, that we might start to get some relative strength here in stocks like AbbVie. You can see that we are in the process of a bullish reversal on the Hakinyashi. We got a transition candle last week, which was a really bullish candle. So those kind of transition candles can typically lead to some good bullish reversals. Already your green arrow here, which means we're above the 10-week moving average. Looking at the daily moving averages here, you can see that you're above the 30-day. You're still not above the 50. The MACD is still not positive yet, but it's pretty darn close. You're above the point of control now. You're at the top of the value area. You're looking to clear the last kind of major volume node in the value area. And you can see the stochastics rising pretty sharply as well. In fact, pretty much all these oscillators are rising pretty quickly. Your negative indicators now below 20. Your positive is looking to stay above 25. Your RSI is jumped up significantly out of bearish territory, and on the CCI easily into bullish levels. Now we need to kind of corroborate that RSI and get up above 60, like it did over here. But as of right now, at least you're not below 40, and you're really kind of changing the narrative here and looking really strong. You can see that you're still below the cloud. You're still got a negative 26-day rate of change. You had a bearish trend, but it's gone. So, and you're above the green line. So at least the bearishness appears to be done. And then you look at the Keltner channels here and the Bollinger Bands. And you can see obviously above the point of control, and you had a relatively low bandwidth. But now we are into the upper bands, and the bands themselves have moved inside of the Keltner channels, but we may be starting to reverse that as the momentum is changing from being strongly negative to potentially positive through these red dots. So if we can get outside those bands, which we're pretty close, and the Keltner channel, then we can have our breakout signal and really get going to the upside. So what I decided to do on this is say, okay, well, let's do a call option, a call vertical, not be too aggressive with it, but we'll buy the at the money call, sell one strike out of the money. You can see what that ends up looking like. It was just buy the 155, sell the 160. Position size for my normal, 50% of normal for a directional trade, but getting about a 2-to-1 reward to risk ratio if it does get above 160. To kind of give you an idea of where 160 would be, if I were to take a look at the 4-week range here, 160 obviously would be a new high point. And here, let me go out a little bit further on the days so we can see kind of where that is. All right, so here is 160 would be right up into here. So we'd be breaking through this, get into this gap of volume, getting up towards the upper end, and really reversing that. So we'd be through to new 4-week highs, which means we'd have a green arrow, a green spike up to 100 on this. We're that close to it, right? We are so close to getting that spike right here. So go back to FD. So that's how close we are. Like, in fact, it probably will turn. We probably will get that green spike up to 100 tomorrow. Now that the red line, we hit 0 on the green, the red line could drop below 70. So now we are due, and you can see we're due for this to break up to the higher end of the ranges as well, as we ideally break outside of that bandwidth and Keltner channels and start to push to the upside. So that if it doesn't work out, then we can kind of keep our losses minimal. But if it does, we can get a pretty decent return for the amount of risk that we're taking on this trade. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember, subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. You can also join our website at marketscholars.com for free. Follow us on Twitter and Facebook, and like and comment there on those posts as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.